So today we are very delighted to have the main speaker, who is Dr. Yossi Shvimer, who is a postdoctoral research associate in the Center for Global Finance here at SOAS. But let me also say that he's a very active practitioner in the investment industry. He's the CEO of MCN Alternative Investments, and also serves in key positions within Megiddo Capital Markets Limited. He has a PhD in finance from Bar Ilan University in Israel. And he's focusing a lot of new research, very highly prolific person, pushing in all frontiers on finance, and especially applied machine learning to finance problems, in particular to investments. And so he has a number of papers on using advanced techniques for financial asset pricing, and his work has appeared in a number of mainstream journals in the finance area. So you are welcome, Yossi, to this session of the Global Finance Seminar. Yossi and I have agreed that we do a kind of a two-person drama in presenting this work. I will just do, briefly. It's a joint paper led by Yossi Shvimer, including myself, and also a Professor Avi Habon at Bar Ilan University in Israel. Okay. I would like to, for the starters, to try to give you the message of the paper, just in case we have to stop in 5 minutes. So that I just want to deliver. What is this paper all about? We know from finance theory that it is absolutely challenging to forecast stock market behavior, and in particular, to forecast stock market prices. Indeed, the theory gives it as an age-old problem. If we look at the efficient market hypothesis, whether you are looking at weak form efficient market hypothesis, or semi-strong efficient market hypothesis, or strong form of efficient market hypothesis, you still have to see how you can integrate information, full information. And even when you do, whether it's private information or public information or confidential information as in a strong form of the efficient market hypothesis, really predicting the accurately the next day stock price for Marks and Spencer or any company in the UK is challenging. But more challenging, much more challenging, and even more complex is to try to forecast the risk level associated with stock price futures. The standard option theory gives a way of insight into how prices in the future and contracts in the future can be done. And whether you are looking at just standard option theory, or indeed a variant of, say, real option theory, still you have a problem of forming the future stock prices because you have unstable predictions you need to make about the evolution of parameters over time. So the novelty of this paper is try to look into this problem and try to introduce a new next day forecasting model for the Chicago Board Options Exchange Volatility Index, the VIX. And the novelty arises from the way we invoke an element of a artificial recurrent neural network architecture in the field of deep learning, a component of machine learning, using the long short-term memory, or what is known in current vogue as LSTM. And this LSTM procedure helps us in many ways. First of all, unlike any standard feed-forward neural networks, the LSTM has feedback connections so that it can be able to process not only single data points, but also the entire sequence of data. And so that's kind of a novelty. If I could go to the next slide. And yeah. And so in this paper, we use this technique, but we also show that beyond that simple use of LSTM, we can add investors' sentiment scores to a new hybrid model that would encompass the LSTM and then the ARIMA model. So the ARIMA comes in as a way of applying econometric tools, which are very well known in the economics literature. The ARIMA basically comprises the two parts, the first being the auto-regressive process, looking at how the stock price today is related to the stock price yesterday, Tuesday, and the stock price on Monday. Okay. And then try to see that as you go back into the past, you have declining partial autocorrelation coefficients. And then the MA, the moving average, is actually looking at the error term of that specification and trying to see even when you take the error term going back from yesterday and the day before, you can learn into the price formation behavior. And of course, the nature of the variable is integrated. So you are combining AR, autoregressive, to moving average and integrated, and then you have ARIMA model. And for forecasting purposes, try to see whether you can be able to forecast into the future. So basically, the addition of sentiment scores here is an innovation. But one innovation here is that the sentiment scores are generated and empirically evaluated via a machine learning natural language processing tool called NLP for natural language processing, which is based on commonly used economic sites. And Shvimer is going to share with you the main sites that were used to generate this NLP up and use the tool. Okay, and so we end up with a hybrid model that shows you the robust results on the forecast of the next day VIX index. And as usual in forecasting, it's very relatively straightforward to forecast in sample. Okay. You can easily have a base track and a forecast, but within sample. What is really challenging and a good way of judging the forecast is to do out of sample. And so we undertake out of sample forecasts for the VIX for 2019 and 2020 end of day data, which includes the COVID-19 out of sample data and therefore incorporates a contemporary China period. So basically, what we show is that if we use the hybrid LSTM and ARIMA model, and then we add sentiment scores from the machine learning tool, then we are able to obtain higher accuracy of 5%, more than simply using hybrid and LSTM alone. If we didn't use investor sentiment scores from the machine learning. So the machine learning helps the analysis of forecasting the VIX and able to generate higher trade profits from such an investment strategy. And that's why we say it works. So in this paper, the roadmap is very clear. You have a simple kind of motivation, which I've cleared. And then we undertake a review of literature and basically reviewing the key recent work on forecasting of VIX, on LSTM, and the combination of ARIMA and LSTM. We then explain how we construct the hybrid LSTM ARIMA approach, how also in a new section to how we measure the news article sentiment. And the approach is almost similar to what Kemi and Toru are using in semiotics, but in here we are basing on certain sources of public information and then constructing the scores from there. We then also discuss the model architecture so that you don't have a black box. That is just indicating of how the model is formed, and then the empirical results from obtained, and then robustness tests that undertaken and the results obtained. And then we conclude showing that this approach can actually generate higher results and higher profits. And so at this juncture, let me pass on to Yossi. I think you have removed the...
Yeah, because I wasn't muted, so it's
okay.
Share again.
Yeah.
Okay, now I hope you can see it. So a little bit about the motivation. So VIX, it measures the expected volatility of the associated option for the S&P 500 for the last 30 days. But I think much more than doing the expected volatility, the VIX is actually considered to be the fear index of the market. So it mainly involved traders, hedgers, risk managers to see what happened with the volatility or with the VIX index to consider whether to change their position or to hedge their position. And it is a quite known benchmark for the volatility, I think for the S&P 500, but mainly for all stock markets. So it's very, very difficult to try to measure it or to try to forecast the VIX itself. Strangely, the VIX forecasting models got very little attention even after the financial crisis. We know how risk was evolving during the financial crisis, but apparently all the papers were trying to predict the stock market rather than to try to forecast the VIX itself, because it's quite challenging, because you cannot try to forecast one price, but you need to find the second derivative of the price, the volatility, and sometimes the volatility of the VIX, in order to have a precise value for the VIX itself. And the empirical results so far have been rather diverse. Some of them were inaccurate, and it was not so much adopted by the capital markets traders. And we try to find a new way to approach those challenging tasks. So in terms of the previous literature, most of the forecasting models were gauge models, which try to find the next day future price based on the volatility of the S&P 500 and index return. Mainly what they did, they take the underlying assets and try to find the volatility of the underlying asset, which is the S&P 500, and then try to modify it and to predict one day ahead. Just to name a few of the gauge models, we have the Hesson and Nandy gauge model, which was built for option pricing. We have Goldstein, Jack Nathan, and Rankel, and also the inverse Gaussian, and some other modification, for example, like jump diffusion for the market. But the main flow for gauge models is that they depend only on the time series itself. They cannot have any exogenous variables to explore for the forecasting of the VIX. And we know there are other factors that involve with the volatility of the market. So, and there are also a new approach of multi-factor models, which is like a linear forecasting or structural forecasting that try to evolve some other factors. For example, the market portfolio from the CAPM model, yield, government bond yields, and other parameters in order to modify the model, the forecasting. But again, from the empirical evidence, none of these models can actually say what will happen for the next day in terms of the VIX level, and not just going up or down in terms of the VIX itself. But from what we saw, I think that the ARIMA and the LSTM approach can, if we can combine them together, we might get a robust result that can be much useful in terms of the accuracy of the VIX. We saw some evidence from Siam and Namini that empirically compared with the ARIMA and LSTM model for specific stocks. They found that the LSTM model achieve higher accuracy rather than the ARIMA model. We saw a combination by Zhang of ARIMA and artificial neural network, which is not LSTM. Then I'll speak about the differences a little bit later. And they show that on the Forex, again, not on the VIX, no one so far yet studied the VIX. For the Forex, they found that if they integrated between those models, they can increase the forecast accuracy. And lastly, Babu and Reddy used in first hybrid LSTM ARIMA. What they did, they took the stock and they divided the time series for a trend, which they estimated with ARIMA, and the noise, which they estimated through the LSTM model. And they try to estimate the one step ahead forecast for stocks, and it gives higher accuracy than. And this is basically Babu and Reddy. This is our standing point to start forecast our LSTM model. So briefly now about the LSTM, and then we'll speak much more about the LSTM itself. But it was introduced by Orchester and Schmidhuber in 1997, and they made some modification for it. LSTM, it's a non-linear model that is specifically designed to learn long-term dependency, which means sequences, and overcomes some of the previously inherent problems of a recurrent neural network. For example, vanishing gradient. I will speak about that a little bit later, but it was something that I think changed how people react to sequences. For example, I heard that LSTM model was used to train Chopin symphony. They learned some symphonies and then create their own sequence for using the LSTM. I don't have the video here, but I'm sure you can find it on YouTube. So what we are doing in our model with the LSTM ARIMA approach, we know that the stock prices and the VIX, stock prices for us, it's the underlying assets, and the VIX itself has vulnerable to behavioral factors, for example, risk aversion, and also exogenous factor, for example, macroeconomic shocks. Some of them it's really, really hard to define and to quantify. And the approach that we thought how to get to this problem is to think like a human being. For example, we know that every trader, before he does a transaction, they will probably read some papers, for example. They will see what happened yesterday. They will see what happened in the last past days before they make the decision. And this is what we did in our model. And briefly on what we did, and then we'll dive into the details. We took the raw data, which is the VIX itself. In our data, we collected data on the VIX from 2017 till last December, and we divided the data for two samples. One is the in sample when we train the data set, and then we try to test it. So we divided the data for 75% go for the training and 25% for the out of sample. And lucky for us, we have the COVID in terms of the VIX. This is something that in terms of the machine learning, it doesn't know anything about the COVID in terms of the volatility and the volatility spike. So for us, it was a very good case study to see whether our model can forecast correctly the VIX level. So what we did, we divided the raw data for trend and for the noise. The trend, we took the moving average of the last 3 days. We found the lag of 3 days using augmented Dickey-Fuller approach to see that the data is let's say stationarity, has a level of stationarity that we can work with, and the noise itself. So for the trend, we use the ARIMA model, and for the noise, we use the LSTM model. So for the LSTM model, we have the input parameters using first the article sentiment. We took two sentiment-related libraries, which was pre-defined lexicon, which means they have a scoring for each word, and then we can build our own tokenized sentiment. The first one is called TextBlow, and the second one called Vader. What TextBlow does, it has a polarity, which means we take, for example, a sentence, we tokenize it, and we separate it for each individual word, and then we try to find whether this word has a positive or negative phrase. This score was used by NLP in order to understand exactly what will be the phrase itself. I will give an example in the next slide. And the subjectivity, for example, how much the text itself is a subjective one or an objective one. And in terms of the Vader, we have the sentiment, which also have positive and negative. And we have another one, which is the intensity, which says how much is the strength of the word. For example, scary or frightened can have higher or lower score in terms of the intensity of each word. We used two libraries because we saw some differences between these two scores, and we try to put them together. So just for an example to see how it works, we have a few words I randomly select from papers. The first one is fear. So you can see that TextBlow polarity and subjectivity is 0. The Vader, which is scaled between -1 and 1, has a negative phrase for him. And the positive itself, the score for the positive is 0. For example, loss, also for TextBlow, it was between 0 and 1, and also the subjectivity is 0, which means it's a very subjective score. And the sentiment for Vader was again negative. You can see another word which is love, just to show the subjectivity. So you can see the polarity is good, which is a positive, meaning that it's usually involved in terms of positive article, for example, or positive feedback. And it's a good subjectivity because this is quite straightforward. And also the sentiment is quite positive, and the Vader positive is also positive. And for example, another word that I randomly asked for direct, for example, and in that case, Vader didn't recognize any of that, but TextBlow used that. So this is the reason why I used the two libraries instead of each one of them. Then what I did, I took all the, let's say, the well-known website, financial websites that I think most of the traders will probably look once a day, and we collect the news articles from them. And you can see which phrase we used for the search, and we obtained almost 80,000 news articles with these words for the whole period. You can see here the average score for all the articles. So just what we did, we built for sentiment score for each news article. So what you see here, the average score is for the in sample. The average score for the whole sentiment score for each newspaper article that we obtain. And you can see that almost I think almost beside the sentiment, the Vader sentiment, the median and the average is similarly. And you can see that we have both very low minimum score and the maximum score, that it was quite diverse, which is very good for us to try to capture the noise. And again, this is our targeting with the LSTM. Here you can see the correlation, the Pearson correlation between the VIX level for each day in the in sample and the score itself. Because, as I said at the beginning, the VIX is considered to be the fear factor. I would expect a negative correlation between the score and the VIX level, which we can easily see here. For example, on the polarity, you can see the negative correlation. Higher VIX level has a very low positive sentiment. And the only one with almost no correlation is the subjectivity. Because sometimes I know it sounds strange why to have this subjectivity for the in-sample, because sometimes the machine learning can understand with the interconnection between previous score. If, for example, one of the news article really much involved in what they try to say for the traders, it might affect even higher than other positive score. So this is the reason why we add the subjectivity. So in terms of the noise sampling, the input parameters are the VIX noise itself for day T, for any given day. And then we have the average daily sentiment score for the whole news articles that we obtain until the closing hour of the trading, for the polarity score, subjectivity score, the sentiment score, and the positive score. And then we took a 5 days lag, which is 1 trading week, and this will be our metrics for the model. So basically, the input is a matrix of 5 over 5, and you can see here how we address the problem. We have a given day T. We collect all the data. We have the noise itself. We have the score itself, and we obtain also the previous 4 days before that, and we try to forecast the noise for the next day. And this is what we built for the in-sample. So for the machine learning, the input is a matrix, and the output is a vector. Then we are going a little bit deeper in terms of the architecture of the neural networks, because it's a nonlinear model. What we did, we divided the LSTM for vectors, for our input vectors, each of them considered 1 day. Then we have a hidden layer, which in the hidden layer rely most of the machine learning procedure, because in the hidden layer, we try to find the interconnection between the factors themselves. And you can see here that it's a sequence. It's not only one vector like the, let's say, traditional neural network. It's a sequence. And the sequence is very important because from each vector, the machine learning can know which information we want to have for the next day. So it's not just a matrix, it's a matrix that learn what happened between the vectors themselves. We used 2 hidden layers for the network, and we have, this is a model that called many to one, because we have many input layers and only one output. And the one output, again, it's the level of the noise. So a little bit about what we did, how is the LSTM layer is look like, and why is it important to use LSTM rather than to use, for example, the traditional neural network. So the LSTM layer has 3 gates. The first one is called forget gate. What it has, we have the input vectors that you see on the previous slide. We have the previous hidden state, which is the previous factors for the model, and we have a previous memory state. The previous memory state says how much information we want to proceed for the next stage, for example, for the next vector. So in this forget gate, we have the previous hidden layer, which is a vector. We have the input vector, and we have a matrices for the weights for the hidden state, and a matrix for the weights, for the input weights. and we combine between them. Then we provide a sigmoid function, which a sigmoid function has an output between 0 and 1 in order to scale that. And then what we did, we multiply what the data that we obtained from the previous memory cell and the amount of information that we have from the previous hidden state. And in that gate, we basically consider which information from the previous layer will continue for the next layer. Why is it is so important to have this one? Because as I said, when we have a simple neural network, we don't have the memory state. And in that case, we don't really know what will be the relationship between the levels of the sequence itself. And for example, if we have some weights and we try to optimize these weights and we don't have the memory of what happened, explicitly let's say the last vector will eventually have almost no weights because it won't remember anything. And this is the reason why the LSTM is very much important for us, because we don't want to capture only what happened on the existing day. Sometimes even I think in psychology, when we have 3 days of, let's say, a positive market, usually people say, okay, it will be the same like today. So, and we try to find those interconnection between them, and this is the reason why the previous memory state is very crucial for us. And basically, a zero state from the memory cell is forget everything, and one is remember everything from the previous hidden state. Then we have the input gate, and from the input gate, we try to understand what will be the new memory state for the next level. And for that, we take the same input vector and the same hidden state vector with other weights, which is another matrix. And then we move it again with a sigmoid function. And we also have a tonnage function, which is a scale between -1 and 1 in order to capture, it's basically to normalize let's say the memory state for the next stage. And then eventually at the end of the process, we get a new memory state. And the memory state, this one consists of what data was from the previous state, from the forget state, and from the new one obtained from the new data that was obtained for this vector. And finally, we have the new memory state. We use another tonnage function in order to rescale again what will be the output for the next hidden state. Again, we have the same input vector, we have a new output matrix, and we have another vector with another matrix of the previous hidden layer. I know that I'm speaking a lot about the vector and the matrix. The reason for that is you are going to see how much parameters involving in this architecture, and I think you're going to be amazed, because we want to measure if we have many hidden layers and many neurons on the hidden layers itself. It involves many parameters to estimate. So just for those who was already familiar with the LSTM model or with other machine learning model, we use an optimizer which is called an RMS prop. Basically, it's keeping the moving average of this squared gradient for each weight. I will not speak about that. It was too much information, I think. We use the loss function of mean square error. And the activation function for us, it's linear. The reason why we use a linear and not, for example, sigmoid or other, because we want to address the specific noise. And we don't want to scale it between 0 and 1. We really want to pinpoint the exact level. And this is why we use the linear rather than other scaled output. We also use a dropout of 20% on the hidden layers. The meaning of the dropout that, for example, if we have on the hidden layer, we have 30 neurons, we took randomly 20% out of every hidden layer in order to to avoid overfitting. If you're not doing that, you will probably, when you will see the in sample data and after that the out of sample data, you will probably do an overfit. And this is, let's say for a sequence, the main thing in order to make sure that you cannot overfit the data. And the total number of parameters of this network, because as I said, each gate has its own vector and metric. The total number of parameters is above 15,000. Again, it is a very small amount, but each one of them is being optimized. And for the ARIMA model, we did something which is, we tried to find the optimized ARIMA model in terms of P, D, and Q on the in-sample trend data. And we use a stepwise optimization of archaic information criteria, which is quite straightforward, I think, in order to find the right level for that. And we found it to be ARIMA 14, 1, and 0. And surprisingly, and not so surprisingly, you can see that the 0 is involving with the moving average. And for us, it's okay because we already removed the trend, and we try to find the trend itself. So the moving average is already in the trend, embedded in the trend. So for us, it's okay to be with no moving average because this is our input for the ARIMA model. And then we used 3 error measurements to see how accurate the empirical result to be for the out of sample. It's quite common. We have the root mean square error. We have also the MAPE and the mean absolute error. So it's quite common these error measurement to see how close each of the models for the real data. Then we use a peer model to see how our model is going to perform for other peer models. So first one, we have the hybrid LSTM without the sentiment score, meaning that the only input vector for the LSTM is the VIX itself. Then we have the ARIMA 111 model. Again, we choose the level with the same stepwise approach, just to make sure that everything is okay. And the ARIMA was for the whole data. It wasn't for only for the trend like we did on the hybrid. And then we have the LSTM. Again, we took the raw data, the VIX level itself, and tried to modify it with the sentiment scores. And we tried also without the sentiment score. And we did try to find another GARCH model, which was another hybrid. We did the same thing, but we measured the trend with the ARIMA with the existing model that we had, and we tried to find the noise using the GARCH. So the residuals from the GARCH will be the peer for us for the noise for the VIX itself. And here you can see the empirical results in terms of the accuracy. The first one is the model with the sentiment. After that, you can see the model without the sentiment. And then the ARIMA and the LSTM. Basically, the LSTM, when we saw the plot of that, it was almost cannot find anything about the jumps during the COVID. It was very good before the COVID, but with the COVID, the LSTM couldn't find the right level of the VIX itself. And also the GARCH, the ARIMA GARCH model was also tested, and it was superior of the ARIMA itself, which was also quite interesting to see in terms of the RMSE. So for us, the error was quite okay. Then we try to find another measurement, which is something that we like to do, is to see if we can make money from that. So we have everything. We have the news. Everyone can take the news, and we have the model itself. And what we try to do, it was a simple thing. If you think that the level of the VIX tomorrow, according to your model, is going to be higher, buy it now, sell it tomorrow, and the profit will be the difference between them. if tomorrow the VIX is going to be down, sell it today and buy tomorrow in a cheap price. And this is what we try to do here. And what you can see here is a superior of the hybrid model. Again, relative to all other models. And you can see what happened here. This is a COVID time. So in the COVID time, I think the model was get most of the information from the sentiment to help him to find the right level or the right signal to enter a profitable transaction. You can see here the money on the future itself, how much for the last year using this strategy. And moreover, you can see that the model has generated much more profitable transaction, meaning that if we do a transaction, we want to make sure that it's going to be a successful one. For example, if we bought the VIX, we want to make sure that we really earn money on that. And most of the performance here was profitable. Usually the average, let's say on a regular model, it's about 50%. It's going to be a good model. So 56%, almost 57%, considered to be very good in terms of profitable transactions. Again, and also it got the right level in terms of the profit. So it's a good transaction and also is a good profit. And we try to do something about the robustness. Usually when people try to do a robustness test for machine learning models, it's quite difficult to do that, because usually, yes, we do that when we do the training. We have a cross-validation set. We did that on our model too. But for example, when we have a model of classification, for example, try to classify between dogs and cats, usually to try to find the robustness, you try to a little bit change or to modify the picture and to see whether the model can still distinguish between cats and dogs. When you do a sequence, it's much harder to do that. So what we did for the test, we try to shuffle the data. So in order to have a sequence of data for the out of sample, first we have the first test to shuffle the VIX out of sample. For example, it can be a stochastic jumps on the VIX itself, and then shuffle also the VIX and the sentiment score, each of them in a separate time frame, and then we try to compare it with our existing model. And again, from what we have, the model is robust because the error is still lower, the profit is still higher, and the profitable transaction is higher. So for us, the robustness test, and I haven't saw any robustness test on LSTM model in the literature that I've been reviewed. I think this is also something that we find out to be very much efficient for test robustness for time series. And again, for us, it was quite positive. And if we can conclude what we did, so we used the LSTM ARIMA model, and we found that we improved the forecasting accuracy of the VIX and higher profit, and the sentiment itself increased the accuracy of the model. And I think that we haven't explored that yet, but maybe other features that we haven't thought about can even increase more the accuracy of the model, especially for the noise. And this is what we are targeting in our model. So thank you very much, and I'll be happy for your comments.
Yeah, thank you very much, Yossi, for a very clear presentation and done so elegantly. That's absolutely enjoyable. You make the hard material seem straightforward and easy. And at the end of it, the paper declares that companies can be able to make profits from that strategy. Well done. Okay, so and now we open the floor for discussion, questions, comments. Let me look at the participant list. Please put up your hand within a question. So first opportunity to Aisha, and then after Aisha.
Hi, thank you, Yossi. It was excellent presentation, and there were many good insights onto machine learning and how we can use machine learning to predict, forecast stock market behavior. Actually, I'm not that much familiar to the methodology. I just want to ask about, maybe I missed that during presentation. How did you measure sentiment? Which indicators you use to proxy sentiment?
Thank you, Aisha. Yeah.
Okay, so what we did, for example, we collect news articles. For each individual news article, we tokenized each word in the news article itself. We scored each word in this article and get, for example, love could be 0.6, and then we average them. Basically, we average the sentiment, which is the overall average score of the sentiment, for example. If we scale it between 0 and 1, all the results, so we average all the words or all the phrase again to obtain one score that measures the average score of all tokenized words in the newspaper. Then we collected for each individual day all the papers, all the scores for all the papers, all the news articles that was published on the same day until the close, few minutes before the close of the markets, and we average them. And this was the score for the same day. So because we have many scores, because we use two libraries, we have four scores. So we have the polarity, we have the sentiment, we have the subjectivity, and we have the positive.
How do you decide the sample? For example, you are talking about the newspapers, the social media tools. How did it decide your sample?
So I collected that data not from social media. I think the social media is a little bit biased. It's usually it's a short term, and some of them with icon or emoji instead of even words. So for us, it's very difficult to understand. But I think most of the market professionals use quite well-known website to understand what happened with the market. And we choose, I think we choose the most known one, and we also rank them. There's an external rank of how important each of the website, and we collected the higher portion of them. It was proprietary data that I was collected through a platform called WebHose.
Okay, thank you so much, Yossi.
Sure.
Yeah, and Aisha, I think you can see some of this on the list of websites used in the discussion. Yeah, thank you very much, Aisha. Peter.
Thank you, Professor. Yossi, thank you so much for a very good presentation. It's very educative, well done. But however, I've got some questions for you. You said that you collected data from two libraries. Did you compare the consistency of the data from these two libraries? One question. Second questions. How about the reliability? Because sometimes these newspapers are certainly promoted by speculators. So they write speculative news. And how do you certainly ascertain? And on your model, which I find it's quite sophisticated, but at the same time, you seems to be showing all the time profit. But mind you, forecasting and especially in this day and age. You can also incur losses. So there's no where within the model where you have factored the potential for losses, because otherwise, if I have to follow you, it will be a perfect model. So this is what I wanted to share with you. Thank you so much.
Thanks, Peter. That's so insightful. Yeah.
Okay, so I will start about the consistency of the data. We had some, I used, again, we collected the data from a platform that collect all the data, all the available data, with the specific keywords that match the subjects that we want to explore, which is the S&P 500, VIX, volatility, and stuff. So we found some of the, let's say, the news providers that they were inconsistency in terms of the provided data, and we exclude everything from, we had, for example, a website called The Street, and also, for example, MarketWatch, and because the data was inconsistently, part of the time they didn't collect the data, so we removed everything, the whole news provider. So what you see on the 13 news websites, there are one that it's always with the same, and they provide always news about the keywords that I was looking for. In terms of speculators, I think you're right about, and we thought a little bit about before we collected the data about speculators and let's say hidden motivation for some of the let's say the writers there. This is the reason why we, for example, didn't use the social media at all. The other part is we collected a lot of data. I think the average per day is a few hundreds. So when we have a lot of data, even if we have some biases, it will be probably on the average, it won't modify much the data itself. But we try to avoid that also by screening the service provider. So CNN, for example, or Financial Times, yes, of course they have some hidden motivation, some of them, but basically most of the traders, they will read the same person or the same service provider all the time. So the bias, the psychological bias could be with us all the time. And regarding the profit, it's not profitable all the time. What I show on the graph, it was a cumulative profit. And for 40-something%, the strategy lose money. So it's in a small amount, because the VIX was after that was a little bit lower. But yes, it not always get profits. It's a cumulative. I will try to share the screen and to see to show that. I think it's here. So these, for example, are losses in our model. So yes, we gain a lot of money during the COVID, but then it includes also losses in part of the time.
Thank you, Yossi, for your helpful response, and Peter for highlighting that the possible hidden motivation of speculators. Very well acknowledged. Thank you. Francois.
Thank you very much for this presentation. I'm interested in the capacity of your model to predict the tail risk. I will explain what I mean. So we know that the portfolio of option using to predict to compute the VIX is changing all time. And in your framework, the trend component is captured by ARIMA model, and the noise component by LSTM plus investment sentiment score. So most of the time, the noise component could be what some people would call tail risk. So, and in this framework, sometimes people use the surface volatility framework to be able to capture what could be the surface of the tail risk. I'm just wondering if your model performed better than these models that use surface volatility framework to capture the tail risk, or how you deal with this, because most of the time people are interested in the tail risk, not the trend component. So how in your framework you are able to deal with this kind of thing?
Okay, so in our model, we didn't try to address the tail risk. I think the COVID is actually a tail risk for the model, but we try to forecast. The main purpose of the paper is try to find the level itself and not try to find the spectrum itself. I agree that if, for example, what usually usually what people do after that, when they have the VIX and the implied VIX, they can then move it for the option itself and to try to figure the surface of and the tail risk after that. So I think I can, maybe for it's a suggestion for other paper after that, when we modify the VIX itself, for example, Garch, as I said, the Henson-Nandy was a closed form for option pricing, and then you will get the jumps and the tail risk itself. So I think the next step after that is to move it for the option price surface.
Thank you, and thank you, Francois, for raising that important point. Oli.
Yes, thank you, Yossi, for an interesting presentation. I even managed to understand something. But my question is about whether this sentiment predicts some events better than others, or there is a linearity assumptions that it predicts any event equally well.
Okay, so what we try to do is try to find. It's not actually to capture the event itself, but to capture let's say the amplitude of the important, or the amplitude of the strong of the event itself. So it won't be linear in terms of the let's say a financial crisis. It could be something that, for example, in the news, it could last more than what happened in the market itself. Sometimes it can predict what will happen in the market, and sometimes it could be, for example, if it's a shock can be last in terms of the sentiment even a few days after that. And the market can go after that, can be a little bit calmer, but everyone will speak about that on the news itself. So the sentiment could last even longer, and this is a reason why the correlation between the VIX, the fear itself, and the amplitude of the sentiment, it's not a linear function, because it's like a scattered around some levels of sentiment. So it's not a linear, and it's sometimes, from what we saw from the time series itself, news can speak about an event even a week later. But let's say the sentiment usually will go down. So if, for example, we have a financial crisis, the VIX can jump. Still, we can see that on the news, price volatility, for example, but the amplitude will gradually go down in terms of, let's say, crisis, the keywords of crisis, or keywords of shock, or losses, or something like that. And it will be with, let's say, much less worse phrase. This is basically what happened in terms of shock.
So, sorry, just a follow-up question. So how do you split between between the news that are basically after the news and between data that is predictive? Where do you cut somewhere, or?
I cut it even before that. So I'm trying to have, let's say, the news that I have on the past week, and try to have one noise for the next day. Meaning that I don't really know, I don't, in this specific model, I don't want to estimate what will be the sentiment for tomorrow. Basically, with this specific model, I can do that. I can produce a sequence of output. I can predict with the model, I can train the model, even not for the noise itself, but what will happen for the noise and for each of the component of the sentiment itself. But for my purpose, I don't need it, so I took it out. But for example, even in Chopin Symphony, what they did, they have a sequence of symphonies, and they created a symphony which is actually a sequence of all the previous data. And this is, we can do the same thing with sentiment. You can actually forecast the sentiment score for tomorrow. But I didn't use that because I didn't have to use that in my model.
Final question. How do you treat the rumor level? Because the kind of the buy on the rumor, sell on the news, and you are looking at the news. So there is a layer of information that if there is a way for you to capture it in the subtlety that is not kind of explicit in, or do you feel that you capture the sentiment captures the rumor layer of the information?
Okay, so the rumor, this is what I referred on the subjectivity score.
Okay.
Subjectivity is exactly that. I try to distinguish between what the specific person think and what he's actually doing. So if it's let's say an objective on CNN or Bloomberg about what happened with the market, the subjectivity is going to be 0. But for example, if I took it from Seeking Alpha, which most of the traders use, and they say, we believe, for example, that the market will go up or down, or we think that we need to reduce the risk, it will come up with a subjectivity. And in our model, we try to combine the score of the objective and the sentiment itself, and to see whether it's correlated between them, and we can produce something with the sentiment combined with subjectivity. Okay.
Thanks very much, Oli, for that conversation. Trying to decipher, is it possible that actually a well-organized, speculators could con the market and pass information that we may not be able to evaluate, and that information may distort the prediction in the model. Let me take Timios and Juliet.
Yes.
Timios first.
Oh, sorry,
Yeah,
Timios.
yeah.
Go ahead.
Yeah. Sorry. Yeah. Thank you, Yossi, for the presentation. I really enjoy it. I will come back to the sentiment and how you calculate it. I just want to understand a little bit about the process. So you mentioned that you choose articles that have these keywords. So, for example, if you choose like an article that has where those words separately, like only S&P, we take this article. Only VIX, we take this article. Only stocks, we take this article. Or the articles need to have all these keywords. One question is that. Second question is, I want to a little bit understand how you calculate the polarity, because you mentioned based on the polarity, you calculate whether the sentiment is negative or positive. Then is it based on the some negative words that they're used throughout the article? How is this done? Because I'm asking because I think that given that the sentiment is an important variable in your model, understanding how it's calculated is also very, very important. That's my question. Thanks.
Sure, thank you. So in terms of the keywords, for me, it's I took each of the words, so it was an OR gate for me, which means I can have a news which contain only the word stocks, or only the word volatility, or only the word S&P, or only the word VIX. The reason why I did that because sometimes they will not explicitly speak about the VIX itself, but they will speak about the S&P, which for me it's the underlying asset. So if something happened in terms of the VIX, in terms of the S&P, it could affect the VIX itself. This is a reason, for example, what I saw for choosing volatility or S&P. In terms of the polarity is a ratio between positive words and negative words. It's simply a ratio between -1 and 1, which -1 is only negative words, and 1 is only positive words. And the what you saw on the positive, it's only the amplitude of the positive side. Beside of that, you have the negative side, which is also scaled between -4 and 4. And what the polarity does, it just divide the positive and the negative.
Okay, so all right. So you just assume, for example, that even if the articles talk about the S&P, because it's S&P, by assumption this will affect the VIX anyhow, right?
Exactly.
So this is what you assume, basically.
Mm-hmm.
All right. So it would be good if you could actually do as a robustness, try to just use only the articles that have these all 4 or 3 words together, not only S&P, not only VIX, not only volatility. I know that there will be much less articles, but if you just use all those together, see whether your results will change significantly. Just an idea. If it's possible, maybe it's not. Maybe this doesn't play any role at all, but if it does, it will be interesting to see it.
I was trying to do that, to try to only have VIX keyword, but unfortunately I didn't have so many data. For example, I have days without even one article about the VIX. So right. I had to do something with other.
Okay. Yeah, I mean, I guess. Yeah. I'm not talking about only VIX. I'm just saying you could just put, for example, S&P stocks volatility, all 3 words together in one article, because in these 70,000 articles, there might be some articles about S&P that might not really be that important, or might not really play that important role, even if an investor reads them, or maybe they go directly to his electronic bean and they don't care about it. So I guess taking them into account is like creating a model where you use something that is a variable or an information that it will not play a role anyhow. So just, I don't know whether this, again, I don't know whether this is possible. You do it. It's just some thoughts about it.
Yeah. I will. It's a good comment. I will think about that. Maybe to do even a robust about this one. So thank you for that.
Thanks. Yeah.
Thank you, Timos, and thank you, Yossi. So I take Juliet, and then after that Richard, and after that Hong, and after that Charles Godfrey. Okay, so Juliet.
Thank you, Professor. Thank you, Yossi, for a very insightful presentation. I think on reflection, I think you may have answered it because my question was coming similar to Orly, and I think Peter asked the question earlier in relation to profit. I was just concerned whether the model actually can pick up that information that you can't see. Let's say, for example, manipulation or something that you're thinking about, or whether the model could actually extend to look at that. But I think potentially you have answered that. And that was my question, whether the model in itself, because the claim initially was around profit, can it also predict or look at the market abuse angle, for example?
I haven't as that, honestly. It's a good point, I think, to address, but my target in this specific paper is trying to have the VIX level. So I didn't really much put attention, and it's a good comment to see what happened, for example, with abuse or other articles. But I try to filter those articles by choosing, let's say, the top news articles in the world. So I hope those like CNN, Bloomberg, Financial Times try to reflect some objective in their news articles.
Okay. No, thank you. Thank you very much.
Thank you, Juliet. Richard.
Yeah, very much picking up on Juliet's point. It will be interesting to see if this model actually
We can't hear you. Hi, Richard.
Can you hear me now?
Yeah, I can hear you now.
Okay. Picking up.
You've gone again. Richard. Richard. Hi, Richard.
Hi, Richard. Hi. Microphone's not working.
I think the microphone is problematic.
Right. Let me see what happens if I do that.
Now, when you do that, we can hear you.
Good. Okay. Picking up on Juliet's point, I wondered whether the model could actually make market abuse less effective. If the model was capable of reducing the impact of market abuse. Now, from your answer to Juliet's question, it sounds like you don't know yet, but that could be an interesting question to investigate.
Yeah, that's great, Richard. Yeah, can you capture, the intentions of a rogue trader? Maybe that's something that may not be predicted from the model, unless, of course, you see that the data shows a strong bias on given information. Yeah. What do you say, Yossi?
I think I can do that. I will share the screen where I can do that. Again, I didn't do it, but I think it's something that I think you can see it now. So again, jumping for the let's say for the Javier staff here, you can see the presentation.
Yes, we can see. Yeah.
So basically, as I said, I spoke about metrics here. So this metric, which is what happened with the output gate, these metrics is actually the weights for the input vector. So if I will see what happened with the subjectivity weights for the whole hidden layer, I can see basically what will be the effect of, let's say, of the subjectivity on the whole model. It will take time, but this is something that, again, it's 15,000 parameters. But if I will try to trace only this level in the layers, I can definitely try to find something in that. But I can also run another model just specifically with and without the sentiment, just to get something about the abuse.
Thanks, Yossi. Yeah. Hong.
Yeah. So thank you very much for the presentation, Yossi, and I learned a lot. And Now, my question is on the model itself, on the economic meaning of your model. So you basically assume that, you know, both the efficient market hypothesis and the behavioral finance are working in explaining VIX. VIX is the volatility index, so which is a summary of all the, you know, financial market volatility. So my question, and your model is basically auto-regressive time series model. So you emphasized in your model, you emphasized the behavioral finance sentiments, you know, and you did very well, and you covered all the aspects of that part. But my question is, what are the fundamental things? Okay, first of all, if you think behavioral factors matter for VIX, then in your auto-regression model, time series model, it is already there, you know. So why did you only focus on the sentimental thing rather than fundamental things? And the second part of my question is, what do you think, what are the fundamental factors that can explain VIX? So that's basically my concern. So why did you pick the sentimental factor out? If the model is time series, it's all auto, you know, regression, you know, different types of models. But if you believe the sentimental factor is an important factor, then it is already in the past information of VIX. So why did you not control, for example, other fundamental factors, other economic factors, for example? So, but that's my question. I do not know how you think about this. Thank you.
So first about the auto-regression part and the, I think part of what we try to do is to capture, let's say, the trend to be a stationarity, so we can actually measure it and try to find, let's say, almost the volatility of volatility, or the spikes with let's say, the behavioral side. We didn't consider any other econometric or other fundamental factors. I think we need to do that in order to even increase the accuracy of the model, but I haven't thought about that, honestly, and I'm looking for other factors. Very easy one, because I want to make sure that they, it will be as simple as they can in terms of other instantaneous factors that I can use for that.
Mm-hmm.
Yeah, I think Hong, your question is very much appreciated in the context of the efficient market hypothesis that all factors would be incorporated. Although there are studies that do sentiment analysis that have dominated the finance literature for many years, the difference here is that the sentiment analysis here is generated from the machine learning configuration rather than from the straightforward sentiment analysis, and that's possibly what makes the difference. But I do appreciate your comment in terms of how information is incorporated into stock prices, and today and tomorrow, which are the forecasts. Charles Godfrey.
Yeah, hello. A very interesting presentation, Yossi, and I have both a question and a comment. The first one is, a couple of years ago, I remember recalling that there was a controversy with the Michigan Consumer Sentiment Index, where evidently traders were paying for it and they were getting it in real time, a few seconds, I believe it wasn't even that long, before certain other users, and the other users complained about it. The reason why I asked that is I didn't recall you saying that you use a benchmark sentiment index, say like the Michigan Consumer Index, just for the sake of argument, to say, look, here's a benchmark index that people use, and here's our index that we constructed. And when we compare the performance of these indexes, here's why ours is better. So that's just, you know, just off the top. If I were a referee, I probably would have asked that. But then a second comment has to do with a recent paper by Frank Fabosi and one of his PhD students. Just came out in the Journal of Forecasting. In fact, the title of the paper is Sentiment Indexes and Their Forecasting Ability. So they look at a set of forecasts, a set of classic sentiment indexes in the literature, and kind of put it in, I don't want to use the, you know, a genetic algorithm type setting, and came up with their forecast. So I would think that perhaps the Journal of Forecasting certainly would be a great outlet for this paper. But those are just my comments, you know. Did you have the key question is, did you think about choosing a benchmark sentiment index, and if not, why not?
Okay, so I think that the Michigan sentiment index is it's not on a daily basis. Again, if I remember correctly, and because I used a daily data, I really much need to use something that I can a benchmark or a daily benchmark that I can be referred to. And this is the reason why I use the sentiment.
Yes. The Michigan sentiment index is a daily benchmark.
Okay, so it's a good comment. So I will add that. The only thing is that I need to make sure is whether at exact time it's going to be published, because it's even crucial for the model itself. So just to give you a sense of what I did on this specific paper, because I want to be a real model and not just something that could be biased. I took all the papers that I gathered until 15 minutes before the closing market. Meaning that if I want to be a real trader, for example, and I want to really trade this algorithm, I can collect all the data that I have until 15 minutes before closing time, run my model. It usually takes less than 1 minute, and then going to execute the trade and have enough time even to have a coffee. So this is the reason why I try to do that. So for me, I really need to understand when is a sentiment index is really published, and what is the time frame. So how it's exactly moved, and I will look on it. It's a very good comment. I will add that for sure for the paper.
Yeah, thanks, Charles, and also mentioning the general forecasting as a possible outlet, and also drawing attention of the paper by Frank and the PhD student that is on forecasting, very relevant publication. Thank you. I see the hands of Peter and Hong. I'm not sure whether that's the old hand or there's a new hand.
Sorry, that's the old one. Sorry.
Okay, thank you.
It's a new one, Professor.
Okay. So Peter, you can come again. Yeah, thanks.
Okay, thank you so much for allowing me the second chance. I would like to ask Yossi. I'm so intrigued with your paper. I will ask you a direct question. What about the capital asset pricing model? Is that all dead? Have you been able to test your model for consistency with the capital asset pricing model using the same set of data? Thank you.
Thank you, Peter.
It's a very good question. I haven't tried to do that because I was trying to find my niche on the VIX itself, because VIX is something that almost no one has been looking on in terms of machine learning and sentiment behavior. I for sure need to do something with that. For the CAPM, one of the slides on the presentation regarding the literature review, I think it was Taylor, a paper of Taylor published 2 years ago. He was trying to do something with the CAPM, but it wasn't involved nor machine learning or sentiment itself. So I will probably try to look deeply on his model and try to maybe adjust it and to see whether I can have higher accuracy for the model portfolio.
Thank you, Peter, and again for mentioning the asset pricing, the classical single factor asset pricing model. It's always the main model on which one basis to do various extensions. So thank you for bringing that into the discussion. There is a hand of Charles Godfrey. I don't know whether I want to come back or this is an old hand.
Oh, no, it's an old hand. Sorry, let me take it down.
Thank you. Thank you. Thank you. Okay, and I'm looking into the chat room, and I think all the points in the chat room are exhausted. I think the last was one by Richard, which was very well covered on model reducing the effectiveness of market abuse. That's a very good comment. And so, any final last minute question, comment, seeking clarification? Yes, Peter, you may come back. Yeah.
Thank you so much, Professor. I mean, as I say, I'm intrigued with this presentation, but given Yossi's background, I'm going to be a little bit provocative, Yossi, and for you to think about that. Given that Warren Buffett is the most successful investors, I'm sure you might be certainly curious to find out what sort of model is he using, and perhaps you could take this opportunity to use your VIX model and so forth to see, have you tried that? Maybe before you could ask him this question, he would really welcome, and he might certainly feel very comfortable that some people are watching him and giving him advice. But that's my final questions. Thank you so much. Well done.
Can I just chime in here and follow up on Louis' comment? Yeah. I think it was in Bloomberg last week. A recent publication from Bloomberg that lists the top 10 hedge fund managers' income on Wall Street. The number one guy generated $23 billion. Medallion Technology, the legendary hedge fund, was still up there in the top 3. So I think this type of model Yossi is, proposing would probably appeal more to hedge fund than somebody like a Warren Buffett, who tend to seem to do a little bit more fundamental investing. In fact, if I'm not mistaken, he usually has disparaging or relatively disparaging remarks to make about what he feels are speculative type of investments. But I just wanted to mention that this would appeal to hedge funds more than perhaps a fundamentalist like Warren Buffett.
Yeah, thank you both Peter and Charles Godfrey for bringing that dimension. I was going to add that, Yossi himself with the MCM alternative investments and Migito Capital Markets is possibly looking into the next application where he will earn his bounty and harvest from this application. It usually, I think, takes a little bit of a step from the this type of research work and then applications on investment. But perhaps Yossi may tell us the way forward there.
Basically, I'm the head of the research department also, so I'm in charge of about 12 billion US dollars. So it's also a nice amount of money. But I think that this model is, if you're familiar with, it's really much related to a company called AQR, systematic approach of investing that this model might be relevant for them. They're doing also long only or short and long, and for that, because I think this specific model is considered to be a systematic one, because you have your own model and you can run it through time. Now I'm doing another model, by the way, for a 1 minute bar. And this is going to be a very interesting one because they made it for something like autonomous driving model for the stock market. So it looks like a picture of a frame of 1 minute, and I'm trying to have the accuracy for the next 5 minutes. So this will probably be the next one, and then of course I will check about the market efficiency. It will be there.
Excellent, excellent. I think we look forward to that next model and that next paper. And by that time, we shall take stock on how this is this particular LSTM model with sentiment analysis is performing in the real sector. So once again, let me thank you, Yossi, for such an exciting paper that generated a lot of comments and discussion and paved the way in looking into investment analysis using machine learning methods. Let me also thank you all the participants who've been able to make it to join the discussion, and all those that have been able to engage in a provocative discussion. I look forward to seeing you again next week. Thank you very much. And we stop the meeting here, and bye-bye. See you soon. Bye-bye.
Thank you.
Thank you again. Thank you very much.
Thank you.